we need to talk about a topic that's causing quite a bit of panic and confusion for finance teams across the UK, and that is sustainability reporting. Right now, there's a big misconception spreading through the accounting industry where finance teams are looking at upcoming ESG regulations and assuming that they're about to drown in an endless sea of non-financial data. They think they're going to have to track the carbon footprint of every paperclip, every coffee cup, and every single commute that their employees make. But here is the actual truth. If you're operating in the UK, you're probably worrying about the wrong things, and therefore you're actually setting your team up to waste hundreds of hours of irrelevant data collection. And so today, we're going to dive into the new UK Sustainability Reporting Standards, known as UK SRS, and specifically, we're going to break down the critical difference between double materiality and single materiality. As understanding this one concept is the absolute key to filtering out the noise, saving your finance team's time, and focusing your reporting entirely on what actually drives enterprise value. And to understand why everyone is getting so confused about what to report, we have to talk about this concept of materiality. And for that, I want us to actually step away from accounting for a second. And instead, I actually want you to imagine that your neighbour has a massive, slightly decaying oak tree in their front garden. And this oak tree is leaning right over your driveway. Now, if you're forced to evaluate that tree using a double materiality mindset, you have to worry about two completely different things. First, you have to worry about the inward financial risk to you, i.e., is a heavy branch going to snap off the tree, fall and smash your car, obviously costing you the repair costs. But on top of that, under double materiality, you secondly also have to worry about the outward external impact. And so in this scenario, that would be, is the tree dropping slippery, messy leaves all over the public pavement, which annoys the local postman and actually just sort of ruins the aesthetic of the entire street. Now that is double materiality. You carry the burden of the financial risk itself, but also of the wider environmental and social impact. But what if you then approach that exact same tree using single materiality? Well, suddenly your life actually gets much simpler. As under single materiality, you don't care about the postman and you certainly don't care about the street's aesthetic or whether the leaves are making the pavement slippery. Instead, you only ask one selfish, highly practical question. Is that branch going to smash my car and cost me thousands of pounds to fix? Now, when it comes to the new UK SRS rules, the government is effectively telling finance teams to just focus on the branch falling on your car, i.e. single materiality. And so how does this analogy actually play out in the actual corporate world? Because sustainability reporting has been heavily driven by the European Union over the last few years, UK accountants are looking across the channel and assuming that our rules will be exactly the same, but they are not. In Europe, the EU uses double materiality under their Corporate Sustainability Reporting Directive, or CSRD. This means an EU company must report on its impact on the environment and society, even if that impact doesn't cost the company a single penny. And so if you apply that European lens, your finance team is suddenly forced to track a vast array of metrics that have absolutely no bearing on your bottom line. Whereas the UK SRS approach is entirely different, as the UK uses single financial materiality. And so the UK framework only asks how sustainability issues impact the company's financial prospects and its overall enterprise value. Now, for us accountants, this is our native language, as the framework is simply asking you to measure the world's impact on your company's cash flows. So under UK SRS, the rule is pretty simple. You can basically just think that if a sustainability risk doesn't hit your wallet, it doesn't go in your report. And so you may now be wondering, well, how do you actually prove this to an auditor? And to prove materiality under UK SRS, you must explicitly connect the external sustainability risks to your standard financial models. You can't just list vague environmental concerns, you must actually quantify the commercial threat. Examples of this would be questions such as, will incoming carbon taxes spike our operating cash flows and squeeze our margins? Or will our lenders introduce strict ESG criteria that severely impacts our access to finance over the next 5 years? Or will banks raise our interest rates on sustainability-linked loans, directly impacting our cost of capital? Now, if the answer to any of those questions is yes, for example, then you have identified a material financial risk. That is a threat to your cash flow and therefore is exactly what you actually report. Now, we know with recent trends in sustainability and finance that as finance professionals, it's time to stop just treating sustainability as a box-ticking exercise or a purely environmental crusade. But the good news is, with single financial materiality under UK SRS, it gives you the mandate to actually filter out all of that irrelevant noise. It actually allows you to focus your team's valuable time purely on the metrics that actually drive or threaten your commercial value. And if you want to ensure that your team is prepared for these incoming changes, you need to know how to structure these metrics now, long before the deadlines actually hit. And to help you do this, we've actually recently launched a dedicated CPD course on UK SRS. It provides a practical, step-by-step guide on how to run a financial materiality assessment so you only measure what actually matters, which ties perfectly into your ongoing professional development without just being another compliance task. I'll leave a link to the CPD course in the description of the video below so you can stop trying to measure the entire world and instead actually focus on measuring your enterprise value. Thanks for watching. Goodbye.